Hello friends, let's have a quick discussion on IS2 inventories. This particular presentation will give you a glimpse of what IS2 has in store for all of us. So let's start. IS2 inventories provides guidance on what is basically inventory. So it provides us a definition of what you can consider as inventory and what is not considered as an inventory. Secondly, it let us know the accounting treatment of inventories. It also guides further on the measurement of inventory. Further, it helps us to know what are the methods to determine the cost of inventory. And lastly, it also helps to know the recognition of the expense in the profit and loss account. So basically, as to inventories consist of these 5 points. To start with the definition that what you should consider inventory, what you should not, because only if it is an inventory then you have to look into the IS2 inventories and the relevant applicable IFRS is applicable, then the accounting treatment of inventory, how you have to measure your inventories, and what are the methods prescribed under IS2 as a guidance for determining the cost, and when to recognize the inventories in the profit and loss account as an expense. To start with, let's start with what is inventory. As per IS2, inventory has been defined as inventory includes held for sale in the ordinary course of business. So basically, if you look at the words properly, then you will come to know that this means the finished goods, because the finished goods are the one which are held for sale in the ordinary course of business. It includes assets in the production process for sale in the ordinary course of business. So basically, if you look at the word the production process for sale, that means that it is talking about work in progress. So inventory which is in the process of becoming a finished goods. The third point is materials and supplies that are consumed in production, which is raw materials. So basically raw materials and till the time it becomes finished goods is considered as an inventory. So raw material, work in progress and finished goods. However, if you notice the definition given under inventory, it specifically highlights the word ordinary course of business. It means that anything which is being sold occasionally or not in your ordinary course of business, then it is not considered as an inventory. So inventory is something finished goods, work in progress and raw materials as per IS2. IS2 is not applicable to few aspects or few areas wherein a specific guidance or a specific IFRS has been there. So those areas are construction contracts, because there has been a separate construction contract IAS or IFRS where the guidance has been provided for how you should account for your inventory under construction contracts. The second is financial instruments, because under financial instruments as well there is a specific guidance under IFRS for financial instruments. So for financial instrument you need to refer only those guidance for the inventory as well. And the third point is biological assets related to agricultural activity and agricultural produce at the point of harvest, which is again IS 41 agriculture. So it's very easy to know that where it is not applicable in the areas where there is a particularly specific guidance being provided under a separate IFRS full-fledged manner. So in that cases, IS2 inventory is not applicable for those. Now, there's another aspect to IS2. IS2 states that IS2 doesn't apply to the measurement of inventories held by. It means that IS2 is applicable to these all areas. However, with respect to the measurement or with respect to the recognition of inventory, it is not applicable. Why? Because there a particular method is already is already acceptable as per the standard of industry. For instance, producers of agricultural, forest produce, mineral and mineral produce are measured at net realizable value. And the second is commodity brokers, dealers like gold and silver who measure inventory at fair value less cost to sell. So basically inventory means what? Inventory means your finished goods, your raw material, your work in progress. The journey from your raw material to the finished goods, everything is inventory. Where it is not applicable, it is not applicable. Where there is a specific guidance being laid down under IFRS and the full-fledged IFRS is there. For instance, construction contracts, financial instruments and biological assets. It is also applicable to other areas. However, the measurement of inventory is not applicable in case of agricultural, forest produce, mineral and mineral products and the commodity brokers and dealers, because specifically their net realizable value or fair value less cost to sell is applicable. Let's move next. The next point is accounting and measurement of inventory. Now we have seen what is inventory. Now we have to look after how do you account for inventory and how you have to measure your inventory. There is a fundamental principle under IAS 2 which states that inventories are required to be stated at lower of cost and net realizable value. Now, if you see here, there are two definitions here, the cost and net realizable value. So both are being defined under IAS 2. What is cost and what is net realizable value? First, let's look at cost. As per IAS 2, your cost should include all like cost of purchase, like taxes, transport, handling, etc. Net of trade discounts. If you purchase in bulk, you get a good discount. So in that case, it's a trade discount at the first point in contact. So in that cases, you need to consider that discount in your cost. However, discounts later on, like while payment, if you negotiate and you get some discount, and those discounts are not considered to be part of a cost. Here particularly we are talking about the trade discount. So cost of purchase, trade discounts, cost of conversion, fixed and variable overheads like direct material, direct labor. If you are manufacturing a product, then cost of conversion is something which you will have to add to your cost of product. Other cost to bring the inventory to its present condition and location. All these costs will form part of your inventory or will form a cost of your inventory. What will not be considered as cost of your inventory will be abnormal waste or storage cost, administrative overheads unrelated to the production. Those which are directly related to the production can be considered as a part of cost under cost of conversion. Then selling cost or foreign exchange differences arising directly on the recent acquisition of inventories invoiced in a foreign currency. Interest cost when inventories are purchased with deferred settlement terms. The more specific guidance is given under IAS 23 borrowing cost. So these costs which are not directly related to your product will not be considered as a cost of your inventory. The cost of inventory will specifically comprise of cost of purchase in case you manufacture it, then cost of conversion, net of trade discount and other costs which is being incurred directly in relation to you bring your inventory to its present condition and location. Now we understood that what is cost. Now what is net realizable value? Net realizable value is the estimated selling price in the ordinary course of business less the estimated cost of completion and the estimated cost to make the sale. So here also if you see the definition has given importance to the ordinary course of business. So you have to see what is its estimated selling price in the ordinary course of business less your estimated cost to complete the sale. So overall you have to see the cost and you have to compare it with the net realizable value. When you compare both, you have to account your inventory at lower of cost or net realizable value as per IAS 2. Let's look at the next slide, which is methods of determining cost. Now, IAS 2 has specifically provided some guidance on methods of determining the inventory cost. To start with, standard cost. In case you have a large production of small items, then you can account your inventory as per standard cost. However, these standard costs are to be regularly reviewed and if necessary, revised in the light of current conditions. The standard cost is used because it's very impracticable for you to know the value of each item of inventory individually. The next method is retail method. It is used in the retail industry for measuring inventories of large numbers of rapidly changing items with similar margins for which it is impracticable to use other costing methods. The cost of the inventory is determined by reducing the sales value of the inventory by the appropriate percentage of gross margin. This is used because it is very difficult in case of retail to identify what is the cost of this item, item 1, item 2, item 3, because they keep a large amount or large varieties of items. However, the margin in the overall items are more or less same. So in that cases, you can use the retail method because it is really impracticable and difficult to find out the cost of each item separately. The third part is, or the third method is the specific cost method. This method is to be used when the goods which you are producing are not interchangeable goods and it is related to specific project, wherein you can identify the cost related to the project or cost related to the goods specifically. Then you need to maintain that accounts and need to know the cost of that particular product. However, if you have an interchangeable items which can be interchanged and which are of the similar nature, similar type and can be exchanged, in that cases, IAS2 has specified two other methods which are FIFO and weighted average cost. FIFO is first in first out method and the weighted average cost method. However, under IAS2, one particular method which is LIFO, last in first out, is not permitted at all. Under US GAAP, LIFO is permitted. So this is something which has to be taken extra cautious because IAS2 doesn't permit LIFO to be as a part of cost or cost of inventory as a method in determining your inventory cost. IAS2 further says that the same cost formula should be used for all inventories with similar characteristics as to their nature and use to the entity. For groups of inventories that have different characteristics, different cost formulas may be justified. Now, recognition. When an expense to be recognized in the profit and loss account. In case your net realizable value of inventory is less than the cost of the inventory, then you need to recognize the amount in the profit and loss account under cost of sales, and this credit impact should be given to inventory. Similarly, when you sell your inventories, you have to recognize an expense in the profit and loss account as a cost of sales, debit and credit inventory. Similarly, when you have an inventory lost or loss of any of that matter, similar nature, then you need to again recognize in your expense in your profit and loss account, which is cost of sales and credit inventory allowance. Reversal of write down of inventory. If you see under third matter where loss of inventory is there, we have particularly used inventory allowance because in case of reversal of write down of inventory, we can use the same account. So in case of reversal of write down of inventory, you can use inventory allowance account and credit cost of sales account. So basically AS2 inventories consist of definition of inventory, how you need to account your inventory, what is cost, the definitions of like cost and net realizable value, the fundamental principle of recognition of inventory, and providing guidance on the methods of determining the cost of the inventory. Thank you.